Here at the Eikenkai Kendo Club in Osaka, ancient ceremonies are played out each week, pitching swordsman against swordsman. But what's remarkable about this club, set up 4 years ago by a foreigner, is at least half of the combatants are non-Japanese. A few hundred miles away, in the Tokyo bond markets, similar scenes are unfolding. In recent years, foreign companies and governments have descended en masse to tap up Japanese investors. The bonds they've sold, known as samurai and denominated in yen, have been flying off the shelves. 2011 was a very good year, raising almost 2 trillion yen, or $25 billion, the best haul for a decade and a half. But 2012 is looking even better, with about 1.3 trillion so far, or $16 billion raised in the first 6 months. Like the Osaka Kendo Club, what the samurai bond market represents is a collision of two forces. Foreigners desperate for cheap, reliable funding, and cash-rich domestic investors desperate for income.
As Japanese market have been performing rather stable among worldwide financial turmoil, a lot of borrowers come here and use samurai bond market as a measure for investor base diversification.
So strong is local demand for samurai that the government of Mexico recently raised $1 billion, but did so without using a guarantee from the state-owned JBIC, the Japan Bank for International Cooperation, as it had in 2009 and 2010.
Originally, the Tokyo market or samurai market should be the open market without any such kind of guarantee. That is the natural cases. But under such kind of the difficult situation, they need some kind of the assurances. And also at the time, they have some kind of the fear for the lacking the liquidity in the market. So some emerging economy is going to have some kind of the assurances when they are going into the market.
It's hard, in fact, to see what could trip up the market from here. A collapse in the currency would certainly hurt, as would a buyer's strike in the market for Japanese government bonds, which would drive up risk premiums for everyone. But fears over Europe are still so strong that investors are drawn to the world's largest creditor nation, as they are to a comfort blanket, keeping the yen strong. And while Japan's commercial banks keep buying government bonds to close the vast gap between loans and deposits, the central bank is increasingly piling in too.
I think you could say that this is probably the most resilient market in the world. We've seen this before, especially last November, when we were looking at the imminent collapse of the euro. And again this spring, when problems associated with Greece was in the headlines every day, yet this market stayed open and allowed numerous issuers, including ourselves, to successfully enter this market.
As long as Europe's woes continue and the sense of Japan's own fiscal crisis seems remote, plenty more foreigners will arrive, bow deeply, and go through the motions. This is Ben McLannahan for the Financial Times in Tokyo.